Good afternoon or morning, everyone, and welcome to the webinar today. Today's presentation is entitled 5 Construction KPIs, Real-Time Tracking for Construction Success. This session is brought to you by Ledgerable, a BTerrell company, where we are in our 35th year of upgrading small and medium-sized contractor from QuickBooks, all legacy or on-premise construction financial application to Sage Intacct Constructions, the only construction accounting application ever named by the AICPA as their preferred provider of construction financial applications. I'm Shirley Locke, Customer Success Manager of Ledgerable, once again a BTerrell company. I'm joined by Ruby Cheng, a Senior Sage Intacct Construction Consultant. Ruby leads a talented team of Sage Intacct construction professionals at Ledgerable. Before I turn it over to Ruby for today's presentation, let's cover a few housekeeping items. If you are here for CPE, today's presentation qualifies for 1 hour of CPE credits. All we ask is that you respond to the polling questions that pop up from time to time. In addition, we ask that you complete our post-webinar evaluation form. The form will be sent out the next day after the webinar. How will the polling question look like and how should you respond? From time to time, you will see a slide that displays a CPE poll question just like this one. In addition, our Zoom webinar software will display a quick form that allows you to choose and submit an answer to the questions. Go ahead and answer these sample questions, which will let us know who will be expecting CPE credit today. Our goal is to answer those poll questions in 20 seconds or so, and then quickly move on with the rest of our presentations. We will disable the audio and video for all attendees on today's webinar to minimize the distractions. But please know that we welcome your questions. To submit a question for Ruby to answer at the end of the presentation, just click on the Q&A button on the Zoom toolbar. Finally, we are recording today's presentations. We will send you a link to that presentation within 5 business days after the webinar. Please feel free to share it with your team members who are not able to join us today. That's wrap up our housekeeping item. Without any further delay, let me turn it over to Ruby for our today's presentation.
Thank you, Shirley, for the introduction. I'm excited to be here with you all today to talk about the 5 construction KPIs that go beyond traditional accounting and give you real-time control over your jobs and margins. In construction, margins are often razor thin, and by the time financial reports are ready, it's really too late to make course corrections. And that's why the KPIs we're covering today aren't just about accounting. They're about giving you real-time control over your jobs so that you can spot issues early, take action mid-project, and protect your bottom line. And the good news is, you don't need to track dozens of metrics. If you focus on these 5 most impactful KPIs, you will have the visibility you need to run a profitable construction business. And here's our agenda today. We will quickly review the learning objectives and then walk through each of the 5 KPIs. For each one, I will explain what it means, why it matters, and then show you a real-world example inside of Sage Intacct. At the end, we will recap and then leave time for any questions you have. By the end of today's session, you will be able to identify the 5 key financial KPIs that every construction company should be monitoring in real time. Evaluate how integrated systems enhance visibilities into cost, revenue, and labor trends. Analyze WIP performance, committed costs, and profitabilities using drillable dashboards. Understand how to track labor productivity across crews, phases, and cost codes. Recognize how to support both project and finance team through centralized reporting. And before we dive into the first KPI, I would love to hear from you. And let's launch our first poll here. Which of these KPIs are you currently tracking in real time? And take a moment to respond here. This will help us understand where you are today, and I'll keep your responses in mind as we go through the materials. And remember, There's no right or wrong answer in any of the polls here today, as we may be at different places in our construction financial journeys. And hopefully, today's session will make an impact in how you view your project KPIs. All right, we are going to start with job cost variance, one of the most important financial KPI in construction. If you have ever closed out a project only to find your actual cost blew past the budget, you already know why this KPI is critical. Job cost variance is your early warning system. It shows you where your budget and reality are diverging while the job is still live. Without it, you're not managing margins, you're just reporting the damage after it's too late. Now, what is job cost variance? Job cost variance is the difference between your planned spend and your actual spend, broken down by job, phase, task, or cost code. In practice, that means tracking labor, material, subcontractor costs, equipment, and others. But here's the nuance. The real-world construction isn't static. Change orders happen. Material price rises. Crews work faster or slower than expectation, and invoices don't always arrive in the order that work gets done. We need to know at a detailed level which cost codes are drifting from budget, how much have we committed but not yet spent, and what's forecasted for the rest of the job. And here's what happens without that visibility. Project managers work from different spreadsheets that are 2 weeks old. Finance is waiting on invoices sitting in someone else's inbox. Superintendents approve field purchases without knowing how they impact the budget. By the time finance pulls a variance report, you might already be 10 or 15% over budget in a cost category. And at that point, the money is gone. And let me tell you a story about a specialty contractor that I worked with a couple years ago. They were halfway through a mid-sized commercial project, about 2.5 million renovation job. Every month, the PM would update a spreadsheet and report back. We're right on budget. The owner was feeling pretty confident, thinking this job was going to come in smooth. But then the invoices starts to hit. A big one came in from the equipment rental company for lifts and generators, plus a series of field purchase orders that had been approved but not entered into the spreadsheet. And when the dust settled, the project wasn't on budget at all. It was nearly $300,000 over. The painful part was that the project team didn't even realize it until the job was basically wrapped. By then, there was nothing they could do to fix it. When I was meeting with them in their office, the project manager looked like he's been blindsided, and the CFO was furious. And the owner told me later that it felt like they have lost control over the project overnight. The truth is, the overruns had been happening all along, little by little, but without a real-time variance report, they were invisible. If they had that visibility, they could have caught those overruns weeks earlier, cut backs on rentals, and maybe even renegotiate with the subs. Instead, they found out too late and had to eat the loss. Luckily for them, after migrating to Sage Intacct and living in an integrated environment, they never had that problem again. Now, let's look at a live example in Sage Intacct. In today's demos, we're using this QuickBooks Portland project. And in the each rows on this report here, we're going to see a cost code. Your insurance, permits, fees, lockups, etc. And for each of the cost code, we also see the estimates from your estimate or contract setup, plus any adjustments to that budget from, we also have the actuals from AP, payroll, and other sources, such as committed cost, subcontracts, and POs. Now you have something that you have agreed to but haven't paid yet. And then we also have the variance, which is the difference between the revised budget and actuals. And here's the power of this view. Looking at the fees line, we have estimated $100, we're actually spending $6,590. And the report will show us a $5,490 overrun. And because this report is in real time, we can catch that while the job is still live, not after closeout. And that's the difference between proactive management and hindsight. And before we move on, I wanted to give you a sneak peek into the other KPIs and how they can all fit into one single dashboard view. So let me just go ahead and pull up the dashboard here. So on the top, we still see our job cost variance report, the one we just looked at together. But if we scroll down a little bit more, we should be able to see some of the other KPIs as well. So next up we have is WIP to keep tabs on the billing versus cost. We then have our committed cost, so you know what's already tied up in POs and subcontractors. And then lastly, if we scroll to the bottom, we'll be able to see the labor productivity here so that you can compare the actual hours to the budget quantities. The beauty of having all of these in one place is that no KPI lives in isolation. For example, if your job cost variance is trending negative, you can instantly see whether it's because of the unbilled WIP, unrecorded committed cost, or lower than expected labor productivity. Now, for this KPI to work, your data has to be integrated and timely. Your job cost variance report pulls data from subcontractor invoices in accounts payable, purchase orders and commitments from procurement, credit card transactions that maps to the job and cost code, labor time entries from payroll or timesheet system, change orders from project management tools like Procore, Sage Construction Management, or Autodesk Build, which all directly integrates with Sage Intacct. The moment an invoice is posted, the cost updates. The second a change order is approved, the budget adjusts. This automation eliminates the lag and gives you the true real-time control. Now that we have seen how Variance report pulls data in real time from multiple sources, let's take a quick poll here. How are you currently managing construction financial reporting? We'll let everybody take a moment here to respond. And think about the sources of your data, like AP, PO, payroll, change orders, etc. And what we typically see is that many contractors are still in the stage of using spreadsheets or running disconnected systems. And that's usually where the problems come from. When your tools don't talk to each other, your reports lag behind reality. And thank you for the answers there. And that's why the KPIs we're covering today matter so much. They rely on integrated, real-time data so that you can make decisions while the job is still active, not weeks later. To wrap up this KPI, the job cost variance shows where you are today, but pairing it with forecasting tells you where you're headed. And that means you can project final cost and avoid unpleasant surprises at the project closeout. And most importantly, you protect your margins by catching problems while you still have time to act. Job cost variance isn't just a report, it's your margin protection tool. With that foundation in place, let's move to KPI number 2, work in progress and revenue recognition. This one is especially critical because it doesn't just impact your internal metrics. It also impacts how outsiders view your company. Bonding companies, banks, CPAs, they all rely on your WIP schedule to evaluate your financial health. And if it's off, even just by a little, it can create major issues. WIP also fits directly into revenue recognition, which means any mistake here doesn't just distort your schedule. It flows into your P&L and damaging credibility. So what exactly is WIP? In short, it tracks the progress of your projects. At its core, WIP reporting answers 3 key questions. How much work has been completed to date? How much revenue have we earned? And are we ahead or behind in billing compared to that progress? The complexity here is that without tying cost to actual progress, many contractors rely on gut feel or milestone billing, and the result is overbilling, which looks good short term, but creates risk of clawbacks, or underbilling, which hurts your cash flow. A strong WIP report links job cost data with billing, so your revenue recognition is accurate and compliant. When companies don't have real-time WIP, we often see the same problem. Overbilling, where PM invoice 100%, even if only 80% is done, inflating revenue. And underbilling, the opposite. The work is nearly complete, but billing lags, starving your cash flow. We also have spreadsheet chaos, where finance is chasing PMs for updates, PMs are chasing the subs, and the numbers never reconcile. And worst of all, when auditors or bonding companies see inconsistencies, credibility takes a hit. And this isn't just a reporting issue, it's a risk management issue. Like my boss always liked to say, if you're not managing risk, then you're not managing at all. I worked with a contractor that specialized in commercial interior. They were really proud of how quickly they billed. Project managers would push invoices out as soon as milestones were hit, sometimes even before all the works were completed. At first, that seems like a strength. The CFO even told me, we're always ahead on billing. Cash flow is never a problem. But when we pulled up their WIP schedule, we found something different. On one project, there was I think 1.2 million contract. The job was about 65% complete. Yet they had already invoiced nearly 90% of that contract value. That put them overbilled by almost $300,000. The problem came to light when their bonding company reviewed the WIP. The numbers didn't line up. The billing far outpaced the actual progress, and it raises a red flag. The agent actually asked, how do we know these revenues are real? And suddenly, the contractor's ability to secure their next bond were at risk. And that was a wake-up call. They realized that aggressive billing wasn't helping. It was hurting their financial credibility. And once they implemented the automated WIP reporting that tied to an actual job cost, the story completely changed. Their schedule started to reflect true percentage completion, revenue recognition become consistent, and the next time the bonding company looked at their book, the response was, this is one of the cleanest WIP report that they have seen. And that single change didn't just improve reporting, it gave company confidence to pursue larger projects, knowing their numbers would stand up to outside scrutiny. Now, switching to our demo project, Quibball Portland here again, we're going to run a WIP report that ties percentage completion and our revenues. And you will see exactly where each job stands. Let me just zoom in up here a little bit so that we can see the numbers. Right away, you can see here, the revised contract price is $509K. Our revised estimate is $432K. And that gives us an estimate of $76K or a 15% margin. And so far, we have incurred a $410K in cost, which means the project is 94.8% complete. And on the billing side, we have invoiced about 98% of the total contract. And that put us slightly ahead on billing, which is a healthy position to be in. And you will notice that you will be able to pull this report for any of the as of date, which supports true revenue recognition and is compliant with financial reporting standards. Now, in addition to that, you will also get to be able to select the projects when you run the reports. So here, you also get to select multiple projects to be running side by side. And here, we're just selecting all of our QuickBooks projects and be able to compare them as to their progresses. So here we can see all three projects in one view. All right. The impact of the WIP accuracy and the revenue recognition is that it leads to a stronger financial credibility with banks, bonding companies. It also leads to a smoother audit with clean and defensible schedules. The cash flow stability also improves since you're not over or under billing. At the project level, PM gets clarity on whether the job is ahead or behind financially. At the company level, CFOs can forecast cash needs with far greater accuracy. To wrap up, WIP is more than a financial exercise. It's about trust, compliance, and cash flow. When you automate WIP with real-time job cost data, not only protecting your margins, you protect your credibility. Now, let's move on to our third KPI, the committed cost tracking, which builds on what we just covered by showing your future obligations before they hit AP. This is one of the most overlooked KPI because it often lives outside of the accounting system. The committed costs are the dollars that you have promised to spend, even if they haven't hit accounts payable yet. Think about your subcontracts, purchase orders, material quotes, or change orders. If you're not tracking these, it's like building a house without knowing what you have already promised to pay for. And the danger is obvious. You think you have budget left, when in reality, most of it is already spoken for. And let's define it clearly. Committed cost includes subcontracts that are signed but not fully billed, the open purchase orders for materials or equipment, the material quotes that you have accepted, and approved change orders, even if the bill hasn't been received yet. The commitments represent your true financial exposure. If you ignore them, your budget report might look fine, but your cash flow forecast will be way off. Sounds easy enough, right? But the hidden danger here is that they need to be viewed proactively and not retrospectively. And here is what happens when the committed costs aren't tracked properly. You will have two project managers issue separate POs for the same subcontractors, leading to duplicated commitments. The finance team will think that a project has $50,000 left in budget, but $40,000 of that is already tied up in unbilled commitments. The cash flow forecast shows plenty of room until these invoices hit all at once, catching you by surprise. These mistakes aren't just inconvenient. They can derail entire projects and erode trust with vendors, lenders, and your own team. I worked with a general contractor once who thought one of their projects was looking pretty good. The cost reports showed plenty of budget left, and the PM were confident that they come in under. But here's the catch. The report only showed what had been invoiced, not what had been committed. When we pulled a committed cost report, the reality was very different. There was $180,000 in subcontracts and purchase orders that was already issued, but not yet billed. A big one was a mechanic sub, and $90,000 that hadn't hit AP yet. There were also two open POs for materials that had been delivered but not invoiced. The result? The project wasn't under budget at all. In fact, once these commitments were factored in, they were already $6,000 over. The true scare was when the CFO realized that their cash flow forecast for the month was off by six figures. Once they had realized that, and after moving to Sage Intacct, that they had this visibility, they avoided cutting checks they couldn't cover, and they started requiring every PM to review the committed cost report on a weekly basis. It completely changed the game and changed how they manage cash flow. And here is an example of the committed cost tracking report that we're going to show here. Again, we're going to see this in action with our QuickBooks Portland project. Each row here is a subcontract or purchase order broken down by the cost code, and you will see the original contract or the PO amount, any approved changes, the revised commitments, and what has been billed to date, and what's still open or retained. For example, look at this exterior specialty line. The original amount that we had here is a $9,000, but a change order then later increased it by $3,000, bringing the revised commitment to $12,000. And what makes this report so actionable is in the details. We can see how much has been billed and how much has been held in retainage, what has been released and paid, and what the current balance outstanding. In the case of the exterior specialties, we have billed and paid the $9,000, but still have $900 in retainage held. And that last detail matters because retainage impacts your cash flow. Without tracking it, you can't properly forecast payment. Now, tracking commitment changes the way you run reports. You can now forecast spend accurately, knowing exactly what's already being spoken for, and gives the CFO real-time numbers for forecasted spend, not just historicals. You also get to prioritize your payments. AP can see now the retainage, the open balances, and the payment timing is going to be more accurate. It also prevents duplication so that the finance and operations work from the same set of commitments and not doubting each other of their numbers. And this isn't just about reporting. Again, it's about running a more disciplined and proactive business. To sum up, the committed cost tracking ensures that you're managing the whole picture, not just what's already being billed. It gives project managers, finance, and executives the confidence that every dollar is accounted for. Think of it this way. The job cost variance tells you where you are, the WIP tells you how much you have earned, and committed cost tells you what's already been spoken for in the future. Now, let's move on to our KPI number 4, profitability analysis. Most contractors know their gross margin at year end, but that's not enough. You need visibility at the job, phase, or service line level. Why? Because not all jobs are created equal. Some types of work constantly deliver higher margins, while others barely break even. If you don't know which is which, you can't focus your business where it's most profitable. From the surface, profitability is simple. You will subtract your expenses from your revenue, and any self-respecting accountant can do that in under 2 minutes. So what makes our profitability analysis special is that it can be analyzed across different dimensions. Powered by Sage Intacct, it can be analyzed at the job level as to which individual jobs or projects are the most or least profitable. It can be analyzed at the service line level. For example, your residential jobs averaging 28% margin versus your commercial job that are only at 12%. It can also be analyzed at the customer or region level. Which clients or geographies consistently deliver better returns? When you only track profit at the company level, these insights are buried. But with dimensional reporting, you can filter, compare, and see exactly where your profits are coming from or disappearing. Here's what happens when profitability isn't tracked at a detailed level. A contractor might celebrate a strong 20% overall margin, only to discover later that several jobs actually lost money. Without visibility, you can't adjust pricing for unprofitable service line. You might keep chasing clients who are dragging down the margin while ignoring the ones who deliver consistently stronger returns. This is like driving with your windshield painted over. You can see the end result, but not the road you took to get there. I've also worked with a contractor who was proud of their overall 18% margin. On the surface, it looked pretty solid. But when we broke the profitability down by the job type, there's a very different picture there. Their residential remodels were averaging a 25 to 28% margin, which is fantastic, but their commercial jobs were closer to a 10 to 12%. Even worse, a couple of the large commercial jobs actually lost money. The owner told me that they have been chasing these big commercial jobs because they look impressive, but they are the ones that are dragging them down. The turning point was when we built the profitability dashboard by the job type and customer, and suddenly it was crystal clear as to which job were the winners and which ones weren't. They later made the tough decision to scale back on the commercial jobs and focus more on the residential work, where they had repeated customers, stronger margins, and better reputation. And within a year that they made that decision, their overall margin jumped from 80% to 23%. And not by working hard, but by working smarter, focusing on the jobs that actually made them money. Now, let's look at how Sage Intacct makes this visible. For this KPI, we're doing something different. Instead of a report, we're having you look at a dashboard. And here is the profitability dashboard where it compares the job side by side. You can instantly see which jobs hit margin target and which ones fell short, and how those results different by customer or by service line. For example, in this view here at the bottom, we see that the total for the restaurant jobs hover around about 22% margin, while next to it, we have our hotels, which is closer to a 12%. And that's a huge difference. And it directly informs strategy. Because instead of guessing, leaderships can now decide, do we double down on restaurants? Or do we adjust pricing on hotels? Do we focus on the project managers who consistently deliver higher margins? And every number here is drillable. So if you click on the numbers, it will actually bring up the report that help you dive into why a job is underperformed. Was it labor, overruns, bad estimates, or unexpected inflations? When you can track profitabilities this way, you move from reporting to strategy. You identify winners, the jobs, PMs, or services that consistently hit or exceed margin. You adjust pricing. If one line of work underperforms, you either raise the rates or stop bidding it. You also strengthen your client mix. If a customer consistently squeezes margins, you decide whether to renegotiate or walk away. The bottom line here is that you stop treating all the works as equal and then start focusing on the work that actually grows your business. To wrap up, profitability isn't just about looking backward at the company-wide gross margin. It's about drilling into the jobs, services, and clients that can drive or drain profitability. By slicing and dicing the results across dimensions, you don't just see histories, you shape your future strategy. Now, let's move to our final KPI, the labor productivity. Often the largest single cost center and one of the hardest to control. Tracking how many hours were budgeted versus how many were actually worked uncovers risks like cost overruns, delays, and margin erosion. If you can't measure labor productivity in real time, you will never know why one crew finishes faster and cheaper, while another runs long and over budget. So what is labor productivity? The labor productivity is about comparing the budgeted hours to actual hours worked, and then translating that into the cost per labor hour. It's not just about payroll. It's about how many hours did crew A versus crew B take to complete the same task? How much did each labor hour actually cost the project? Which cost codes are consistently running over in hours? And by tying the labor hours directly to task and cost codes, you get a real measure of field efficiency. And then you can make adjustments before the project slips away. When labor isn't tracked properly, a few things happen. You will have your hidden overruns, where jobs look fine on paper, but the actual crew hours are running 20% over budget. You then might get schedule delays, where labor inefficiency will cause slippage in the project timeline. You also have misallocated crews, where some teams work much faster, but without data, you don't know who should be assigned to where. Here's another example. I was working with a contractor who swore that the material prices were the reason that they were losing margins. The lumber, steel, drywall, all of it had gone up. And they were convinced that that was the whole problem. And that was right around the time when COVID was over and all the prices were jacked up. So his claim made very much sense to everybody. But when we helped them to start tracking the labor productivity, a very different story came out. On one project, their drywall installation was budgeted at 500 hours. The crew actually took 620 hours to finish. And on another job, the concrete finishing was supposed to be 400 hours, but it ended up at 490. And it wasn't just one-offs. We found the same pattern across multiple jobs. The crews were averaging about 20% over budgeted hours almost every time. And the owner told me right there and then that they had been blaming suppliers for months, but it's actually their own labor that's killing them. The low point came when they realized that one of their best customers, someone they'd worked with for years and had a really good relationship, started to question their bids, saying something like, "Why are your labor numbers always higher than your competitors?" And trust me, that's a tough conversation to have. The turning point was when they drilled down into the data and saw that some crews were actually hitting or beating the budget. One framing crew consistently finished in 480 hours instead of 500, same scope, same type of work, and that was the breakthrough. Instead of blaming the materials, they started shadowing the more efficient crews, documenting their processes and using them as the benchmark for the rest of the crews. And within 6 months after they started to do that, they're able to cut average labor overruns in half. And the owner later said that for the first time in years, they feel like they're actually in control of labor instead of having labor controlling them. And here's what labor productivity looks like in Sage Intacct. Again, we're using the dashboard view here because we have multiple reports to get a full view on this KPI. First one is labor cost summary, where it compares budgeted versus actual labor cost. We also have our labor productivity reports, where it tracks the hours by cost code, highlighting variances. We also have the labor hours by project, shows the total hours worked by cost codes and cost types. This detail matters because it lets PMs and superintendents to see performance by task, by crew, and by project, and adjust things accordingly. The different perspective offered by these three reports bring you a holistic understanding of your overall labor situation. The report is also supported through timesheet entries, either organically within Sage Intacct or through an integration from a payroll system such as ADP. The power of labor productivity tracking is how it aligns with the whole team. Your project managers can reallocate crews mid-job to keep tasks on track. Superintendents sees variances by day or week and can intervene before labor costs spiral. The CFOs and controllers finally get to see the true cost of labor per project, not just the company-wide payroll total. And this isn't just about efficiency. It's about protecting your margins by making mid-course correction. To wrap up, labor is your biggest cost center and often your biggest risk. And by tracking labor productivity and cost per labor hour in real time, you gave your PMs, superintendents, and finance team the data that they need to act early, whether that means reallocating crews, revising the schedules, or protecting the cash flow. Together, these 5 KPIs, the job cost variance, the WIP, the committed cost, profitabilities, and labor productivity, form the foundation of real-time construction financial management. Now, before we wrap this up and move to some questions, let's take one last poll question here. Which of these KPIs will you be tracking now in real time now after today's session? Again, you're neither right or wrong on this, but my personal favorite is the last answer. But don't take my word for it. And hopefully, during today's session, we're able to give you some helpful tips in helping you make your next project better. And let's wrap up our pool here and move on to our next slide. Here, we will recap the 5 KPIs real quick. The first KPI, we have our job cost variance that gives you your real-time visibility into where your jobs are drifting from budget. The work in progress reporting ensures that your revenue recognition is accurate, compliant, and trusted by outside stakeholders. We also have our committed costs, where it shows you what's already been spoken for, so you don't get blindsided by obligations that's not yet been billed. The fourth one is profitabilities, but specifically by job, service line, or customer. That helps you double down on what works and fix or exit on what doesn't. And lastly, we have our labor productivity, your biggest cost center. Shows you how efficiently crews are working and where adjustments are needed. And together, these KPIs from a single source of truth for both finance and operation, and it demonstrates the importance of real-time monitoring and having an integrated system that provides actionable insights. By leveraging these metrics in real time, using tools like Sage Intacct, you can make informed decisions, optimize your operations, and drive your business forward. And thank you for your time. I will now give the floor back to Shirley.
Thank you, Ruby. Will you stay on the line for questions?
Yes.
Yeah. Now's the time to submit questions for Ruby by using the Q&A button in the Zoom toolbar. While you do that, let me do a bit of advertising for other professional presentations available by the Ledgerable team. If you enjoy these presentations, please note that BTerrell is available to speak to construction back office professionals, CPA firms, Texas CPA Society, or CFMA local chapters, and other professional groups on the following topics. The first one is accelerating the financial close. Automation today, AI tomorrow. Another is changing technology, creative disruption, and accounting professions, driven in blockchain economy. And the last presentation, entitled Prosperity Through Recurring Revenue, Unleashing the Power of Subscription Economy. These apply to those specialty industry subcontractors who provide service maintenance agreements to businesses or customers after project completions. In addition to these presentations, please make plan now to attend the following upcoming webinars or meet us with your local or favorite Ledgerable professional. Our next webinar is already in the work. Plan now to attend how Sage Intacct and Sage Construction Management connect teams for success. Scheduled for Wednesday, October 22nd at noon Central Time. Scan the QR code now to register. Don't wait. Also, join us at the following trade shows in October. The CFMA Lone Star Conference in San Antonio on October 26 to 28, and the Chicago Build Expo on October 29 to 30. Finally, Brian will be speaking in September at a couple of Texas CPA local chapters, including the Corpus Christi and Southeast Texas chapters on the following topic: accelerating the financial close, automation today, and AI tomorrow. If you are a member of either of those chapters or either of these cities, we hope you will come out for the presentation and the CP credit as well. Okay, let's see what question we have for Ruby. Well, here's the first question we got. Ruby, how often should this KPI and report to be looked at?
I would say that's really of user preferences. In my opinion, the job cost variance and committed cost and labor productivity should be reviewed at least on a weekly basis so that you can make mid-project adjustments. WIPs and profitabilities are usually monthly since they typically tie to the billing and financial closes. But that's really just the bare minimum. PMs and owners run their projects differently. Some likes to keep things tight, whereas others don't. But you can decide whatever frequency works best for you because the system updates in real time. So if you want to check daily or even 3 times a day with each meal like the doctor prescribes, the data is there. We can even get Sage Intacct to run the reports and email them directly to you at your preferred frequencies. So it's real flexible.
Thank you, Ruby. We have another question. How hard is it to pull these reports if we don't have everything integrated yet?
Well, you can always start small. So most contractors begin by pulling the AP, payroll, and purchase order data. Integrations make them seamless, but you don't necessarily need every system connected on day one. The key here is moving away from static spreadsheets to a system that updates automatically, even if it's just the core accounting data to start. And your accounting system is always the easiest to begin with. And if you're not there yet, no problem. Start tracking them in Excel. Anything that you're willing to start doing will help the project. And it is always better than not doing it at all.
Thank you, Ruby. We have one more question come in. So the question is, if we already track those KPI in Excel, why do we still need to do it again in the system?
Thanks, Shirley. That's a really great question. And honestly, that's where most contractors start. The challenge with Excel is that it's always after the fact. And by the time your spreadsheet is updated, the job is already moved on, and the decisions are being made on the outdated data. to keep track of such amount of data, you're looking in Excel, you're looking at multiple tabs within multiple files that there's going to be complex formulas and linkages between the cells and the sheets. You also will have multiple different people working on the same file or having different versions of the same file, and or someone accidentally fat finger or changes something and the formula and the links suddenly doesn't work, and you will spend numerous amount of time troubleshooting why it didn't work. And with all that, knowing Excel, it will crash also constantly. But with Sage Intacct, you don't have that problem. The KPIs updates in real time. Again, as your invoices, POs, subcontracts, labor entries, change orders are posted, it updates instantly. And that means the project managers and finance teams are all looking at the same live numbers and not waiting on manual updates. It's less about can you track it in Excel, because you always can, and some people always will. But it's more about whether you can track it fast enough to take action before the project slips, because that's what it matters when it comes to managing a project. Thank you.
Thank you, Ruby. Again, thanks to those who shared these important questions, and thank you, Ruby, for the good responses. We will reach out via email to address the rest of your questions after the webinar. And now, thanks again, Ruby, for the hard work on preparing and delivering a quality presentations. And thank you, Sophia, for all the hard work behind the scenes. They make it look easy, but I know it is not. Finally, thank you to all our attendees. We appreciate your time and attention today. To find out more about Ledgerable and Sage Intacct construction, use the links showing on this slide to stay in touch. And remember, we will be back on October 22nd at noon Central Time for another informative webinar provided by Ledgerable, a BTerrell company, entitled How Sage Intacct and Sage Construction Management Connects Teams for Success. In the meantime, please remember that together we build something special. Thank you and have a wonderful day.